Hi there, welcome to Kneppy Invest and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. What I'm going to do in today's video is I'm going to start off with looking at members' questions and comments, then I'll gravitate towards the non-members' questions and comments. And I think I might do this moving forward. A lot of members' questions and comments. I might do standalone videos on those particular questions, but not all of them. But I will intend to answer every single member's question and or comment. So let's get stuck into it. Now, so far I have released 4 videos for members, members only video, and the most recent one was this morning, why I bought Steadfast. Probably my lowest conviction long-term hold, or lowest conviction high quality company I do own at this point in time. So I do intend to own this for the longer term, but I do think it's attractively valued at current prices. So let's go back to the second video I did release and have a look at some of the comments in this. And we'll list this by, we already got it sorted by newest. That's good. Sometimes you have to check this because the standard for YouTube Studio is not newest, it's most relevant, which I have no idea which is most relevant. Anyway, the very first comment on one of my members only video was my own comment. For some reason, Flight Centre wasn't in the list of my trades, but I am trading at Flight Centre right now. And I actually did have a look at the chart for Flight Centre just before I started recording, and still looking pretty good. Anyway, the first question or comment I want to touch upon is from IMCar, and I've decided to do a standalone video on this particular question. Particularly, there was a reply. So I tend to either answer these questions in the comment section or answer these questions and or comments in this particular video, answer and reply video. But IMCar did mention that he would like some trading, education, learning videos. And also, could you explain the scenarios where you typically add to your positions in trades like these? And the other comment here is a technical analysis video covering structure, entries, and when to add positions will be extremely helpful. So I'm going to do a standalone video on that. And more than likely, I have thought about which companies I could use to enter this. And more than likely, companies like Superloop or Corvest, particularly the weekly chart for Corvest, is a really good structured chart. Anyway, so I'll do a standalone video on that. The next little bit of comment, it was sort of like a request from Hills Distributor. Once every 2 to 3 weeks, a screenshot of your long-term portfolio and quick discussion only for members to see would appreciate it. Yes, I'll probably do this more than likely, and I could do this via ShareSite. Now, in ShareSite, my plan, I have the capability to have 4 portfolios. If I want more than 4 portfolios, I have to upgrade. And at this point in time, my 4 portfolios are grouped, which is an exercise I did 5 years ago. I asked the members, well, not the members, but the viewers of this channel to choose some companies I thought would outperform the market over a 5-year period. And that 5-year period ends in September next year. So 9 months away. So I don't want to get rid of this particular portfolio. My other 3 portfolios I am tracking, Kneppy's trades, which is something more personal. I won't get into that. And then I have a quality and technical portfolios. I just wanted to see which strategy I am better at over a long period of time. So high quality companies and technical. At this point in time, I'm just going to show you this really quickly. At this point in time, I think I'm a better trader than long-term investor. My quality portfolio, however, is doing fairly well, up 23.56% per annum versus the STW up 12.57%. So it's doing fairly well. It's almost double the market, which is actually my ultimate aim. So I'm not going to be poo-pooing that sort of results, but I do or should compare it to my technical portfolio, and this is doing really well. So currently up, come on, just take your time, ShareSite, no need to rush. Up 42.65%. Now, it doesn't have per annum there. I'm not sure what's happening with this particular portfolio, but it's at least, because this has been going since middle of 2023. Yeah. So this has been going since the 1st of July 2023. So probably the total return would be, I'm thinking, actually it might be fairly similar to my high quality portfolio. But I'm not sure why this is not per annum. I was trying to fix this the other day, and I just could not fix it. I don't know why. Anyway, so they're both significantly beating the market at this point in time. Anyway, so two strategies that are doing fairly well. And you don't need just one strategy. You can have a few strategies. And I do have two strategies that I'm following. Anyway, so I'll do that, and I'll use, if I go back to my quality portfolio, yeah, I just might go through all the companies I own using a share site. I was thinking of actually just going to Netwealth, because all my high quality companies are in Netwealth, but it's not the Netwealth platform is not conducive for a video like this. Anyway, Kane's boy, how did you end up with EMA crossover of 2,500 over other timeframes? Suits your style better, or maybe more success on the stocks you like? Now, I do prefer the 2,500 day crossover. Now, when it comes to week, I don't usually look at the weekly 2,500 day crossover. Maybe I should. I do prefer now to focus on the 200 week moving average for higher quality companies. But for some reason, I just gravitated towards, if you go back to Flight Centre, I just gravitated towards 2,500 day. I know some other experts use 50 to 100 day. Jason McIntosh does that. And there's all these other different moving averages you can use. So it's not set in stone. You have to use this. You can find whatever works for you. And for some reason, I've just come to the conclusion that for my own technical strategy, or using my own technical strategy, well, this particular moving average is best for my own technical strategies. If I just come to that conclusion over a long period of time, would have been over like a 10-year period of time. I've used all different types of moving averages, and I just like this one. No research done, and this is the best moving average strategy. And the other thing I should mention is when it comes to crossovers, I just don't look at crossovers. I look at quite a few different things. For instance, structure. Structure is very important, as I'll talk about in a standalone video. And you can definitely see the structure changing. Flight Centre, no more downtrend, no more lower highs and lower lows. It's now moved to higher high, and the share price now is at say 9-month high. Anyway, so no reason why no research showing that 2,500 day moving average crossover is the best. And maybe I should look into that. Maybe, is there any sort of research? I don't know. Kane's boy was also trying to jack GPT with no luck, an alert on the crossover indicator to help with trades. Haven't even thought about doing that. Okay, Manish Garg says, please make a video on your short-term tech small cap mining shares also. So I am trading some, I'll probably call these lower conviction trades, but there is an article I want to do a reaction to called The Holy Grail of Investing, How to Spot ASX 10 Baggers Before the Massive Pile In. Interesting enough, this particular article was released after I started this little strategy. So this is buying smaller companies that have the potential to become multi-baggers. But conviction in these companies are smaller, so have smaller position sizing. In fact, I think someone asked me that question. So for instance, right now, Lumis Diagnostics would be at the top of this list. So a lower conviction. So I'll put like $1,000 in this one at 6 cents or something like that. It's now at 28 cents. And I want this to become a 10 bagger. So what I'm looking for is 10 baggers here. Much higher risk, but the much higher reward. And this particular article is a really good explanation on exactly what I'm looking for. I was shocked how close this article was to what I'm trying to do with this particular strategy. So this is not my high quality strategy, not really my technical strategy, because technical strategy, I'm looking for bigger companies, and usually those bigger companies, they're lower risk, but and lower returns as well. I'm not looking for 10 baggers with those sort of positions. Another one is Alvo Minerals. Share price for some reason popped up, and probably the best example of this is not one I traded. If you have a look at Dateline, DTR, Dateline, this is exactly what I'm looking for. So this one popped up back in April, so not that long ago. Share price was below 1 cent, popped up, massive volume coming in. That's another thing I look at, massive volume coming in. And the share price went from below 1 cent to a high of 68 cents almost. So that's a 68 bagger. in a fairly short period of time. That is what I'm looking for. But you can see the share price has pulled back from 68 cents back down to 20 cents. So there's going to be a lot of volatility. And even during that rise from 1 cent to 68 cents, the share price at one point dropped from 16 cents back down to 8 cents. So there's going to be a lot of volatility. And that is the main thing with these sort of setups is you have to be able to handle that sort of volatility. Anyway, so Alvo has been my biggest success so far. So I bought, what was it, at 3.8 cents the day it popped up, and it's already gone as high as 9.5. Other successes in this strategy so far, I do have my silver stocks in this strategy, but I put a little bit more money into those. What else has been good so far? Well, a lot of these are fairly new, we'll say. Well, Loomis has been the best one. This was sort of like my first one. Star Farmer was my second one, but I've already sold out of Star Farmer. And the main reason behind that is I'm just, I wouldn't say worried, but yeah, well, the share price did pop up 15.6% on Monday, but it looked like the structure was trying to change, and the volume, I just didn't like the volume as well. There's like very little volume. A little bit of higher volume did come in on the Monday. Okay, so it actually doesn't look that bad now. I was waiting for this big volume day or bigger volume day and a big up day, but it finally happened with Star Farmer on a Monday. Anyway, so I'll do that also, that sort of video. Not every single week, maybe every few weeks. Okay, Chandra Chef. Hi, Kneppy. Happy to be a member to the wonderful insights you share. Your thoughts on Siteminder, please. Sounds like it has the making to be a high-quality company with a potential moat nearing break-even. Is it a good long-term hold? Okay, for me personally, long-term holds need to be quality companies. I doubt Siteminder would be a quality company right now. It needs a little bit more time to prove that sort of thing. Where is Fiscal.ai here? I should have, there it is, it's called FinChat. I should change the name. I doubt Siteminder would be at that point just yet, but it has the potential. And I am actually willing to hold companies that I wouldn't consider high quality just yet, but have that potential. I do actually have a few of those in my super, but they're just a few. In fact, I'd even put 0 at that point. Siteminder, does it have it's interesting. I'm not sure if I would consider Siteminder to have a moat. What I'm going to do now is just going to do something really on my other computer. I'm just going to do something very quickly. No, not that. The question becomes, does it have a moat? I did actually have a look at this a while ago, and I was going to kind of try to find, and I did actually ask about the moat, and apparently Morningstar has assigned Siteminder a narrow moat, and Guru Focus has given it a moat score around 5 to 10, supporting the idea of a solid, narrow moat. So there are switching costs. So when this company deals with software for hotels, something like that, Siteminder develops, markets, and sells online guest acquisition platform and commerce solutions for accommodation providers in all around the world. Its online guest acquisition platform includes Channel Manager that allows customers to sell their rooms on all connected booking sites at the same time. So there is a bit of a switching cost, which probably does increase their moat. But I thought maybe there was a bit of competition in this space, and there is a bit of competition. In fact, that is one of the reasons why that would be considered a bit of a narrow moat. So Siteminder moat comes from high switching costs from hotel customers, scale advantage that lowers integration costs and widens reach, network effects, strong integrations across OTAs and PMSs, moat strength narrow, durable but not unbreakable. So there is competition in this space. But the main thing I wanted to talk about was the company is close to profitability. Now, if Siteminder, by the way, Siteminder's market cap is about 2 billion, 1.73 billion. So if Siteminder's market cap was 873 million, I'd be way more keen. Of course I would be. It's like saying, well, if Nvidia market cap was $2 billion, I'd be way more keen. I'd probably put all my money into it. Anyway, but that's stupid. Anyway, so Siteminder is not yet profitable, but one of the things I do like to look at is nice growth in revenue. So revenue is growing. You saw a bit of a dip in 2021, but it's understandable. People weren't traveling as much. But revenue has more than doubled since then and not yet profitable. That's probably the one thing I'd be looking for, but it is getting to that profitability stage. It's getting very close. And then you're going to see scale. You're going to see operating leverage come in when they become profitable. And you're going to see, more than likely, the first year they become profitable, the P ratio is going to be extreme, but then they might quadruple their profits in one day. So there's a reason why it is extreme. So my only, I wouldn't say concern, but my only, I wouldn't say it's a red flag. It's just the valuation of the company at this point in time. But with Zero is a great example of this. With companies like Siteminder, you're going to see a lot more volatility because it's harder to place a value on the company because they're not profitable. Now, if you have a look at Zero at the start of its life, go all the way back, there was a lot of volatility here. So a lot of interest in Zero when it came on the market in 2023. Share price went from $4 up to $42. And because of lack of profitability, the share price then pulled back from $42 to $12. And then, then they went through a period where the share price just went bonkers. I'm actually more willing to trade these, it's like Siteminder, than hold it for the long term, just because there is a little bit more uncertainty. But if you do believe the management, you do believe what they're trying to do, maybe a long-term hold, because Zero, if you held it for the long term, you've done fairly well. You just have to handle that sort of volatility. Siteminder, we'll have a look at the chart for Siteminder. And I would assume Siteminder's chart has been quite volatile. So it listed, what company? Ballador. I know Ballador Technologies. They owned a bit of Siteminder. That's the reason I actually discovered Siteminder, is because of Ballador. What's the ticker code? BT. Is it BTI? Yeah, BTI. They're sort of like a private. They buy into private tech companies, small tech companies. They probably would mention Siteminder somewhere. Here we go. Siteminder, partial realization and continued investment. It's one of the reasons I actually do follow this company, is because they have not spun off, but they have invested in two companies that have listed on the ASX. Siteminder, and the other one was it's a smaller, much smaller company. I forget what it is, but Siteminder is by far the biggest one. So Ballador has announced it has completed a $25 million cash realization of its investment in Siteminder while retaining 75% of its holdings. So it did sell off some of its shares at $7.21. Let's see if they've done a good job with that one. $7.21. Oh, they nearly got near the top. Anyway, I can just look at this chart, how volatile it has been. They listed, share price, and then went from 750 down to 250. So share price dropped 67%. And now the share price, in fact, the share price got back up to 750 and has been dropping again. So a lot of volatility. You have to handle that. But definitely a company that has the potential to become high quality in the future. And I think this all depends on whether you consider it to be a quality stock or not, or potential to be quality stock or not. Ben Hutchinson says, go Galan. So I am trading Galan, been steadily building my position size. There's potential to be a 10 bagger. So Galan isn't in my smaller stocks, because this is a more real stock, put it that way. So a lot of my trading, my small cap trading positions are story stocks. And if you do read this article, yes, that's where you find a lot of the 10 baggers, story stocks. And the reason behind that is explained in this. And the main reason behind that is it's really hard to give a valuation. It's all about sentiment in these sort of companies. It's almost impossible to put a valuation to some of these companies because they're pre-revenue. Okay, so Galan. By the way, we'll have a look at the Galan chart. So this is one of, was it 3 or 4 lithium plays I'm in right now? And yeah, so I got in a little bit later than I wanted to. So in hindsight, but the share price has gone up nicely since then. Yeah. So for all these lithium plays, really the shift in sentiment and the trend started in the middle of this year. And just look at the share price. Upside is pretty high if lithium price has gone on a massive run. So upside are pretty high. Even if you get a little bit late, there is still potential upside. The other thing this article mentions is to get a 10 bag, you can't sell. You can't sell. And a lot of people sell really quickly. They're up 20%. Oh, I'm going to sell. So one of the keys to 10 baggers or getting 10 bagger is patience. And Ben Hutchinson, I think, and one of the ways you can be patient is around conviction. If you have high conviction, you're more willing to be patient. And it looks like Ben Hutchinson has a lot of conviction around Galan. So he's more potential to be a long-term holder of this and get that 10 bagger if it happens. Ben Hutchinson, however, is stingy, paying $1.30 for Stealth Group. Maybe I'll regret that later. Maybe you won't. Although I did say, though I try not to regret any decision or lack of decision, but it's only human nature to look back at your decisions or lack of decisions and go, well, I wish I did that. But you'd be doing that all day. Oh, I wish I bought Bitcoin in 2009, or I wish I bought Amazon in 2000 at $6, or I wish I did that. Anyway, so the main reason I actually did buy Stealth Group, the share price popped up. Pretty sure that was an acquisition, and the share price pulled back, and I went, ooh, nice little buying opportunity. And the share price, I bought it at 113, so I was a little bit early. So on that day, the share price dropped 11%. I'd have bought it at open, I think. Then the next day, share price rallied. That was sort of the day I should have bought. And since then, the share price has gone up. Okay, what else do we have here? Kelly Maas says, I like this type of video. Would you please do a similar video on high dividend stocks on ASX with good technical charts from your perspective? Similar video on high dividend stocks on ASX with good technical charts from your perspective. So high dividend. So I'm wondering how I could do a screener for that. High dividend stocks with good technicals. Maybe just, I'm not sure if I could do that in Fiscal.ai. Something I'd have to think about doing. Okay, let's go back to potential trades. Only one comment on this one so far, and that was from Ben Hutchison. I'm liking those New Zealand stocks, SKC and FBU, so Sky City and Fletcher Building, which perhaps have macro tailwinds as New Zealand rates come down further than Australia and their deep recession ends. I'm even thinking they're coming out of that, aren't they? It's looking pretty good in New Zealand right now. And both these charts, well, at least Sky City is looking really good, because I had a look at this the other day and I went, ooh, well, I've been having a look at this last few days, the last few weeks, and it's starting to look pretty good. It's starting to look much better than it has been. So is this the turnaround? Now, in saying that, it started to look okay back in February, March 2024, but that was sort of like a false dawn. But maybe this is a bit of a shift in sentiment. Maybe the bottom has been reached, which was at 56 cents, already up to 79 cents. And the other one was FBU. This one was on the precipice of breaking out. I think there was a pullback, and then the share price rallied. So, yeah, the share price is just above that breakout level. And, yeah, this is showing signs of a bit of a turnaround too. Share price has reached recently a long-term high. We're talking about an 18-month high. Actually, even longer than that. Maybe a 20-month high. So the chart is starting to look pretty good for Fletcher Building as well. Okay, now on to your comments. And for some reason, I had two of these YouTube studios up here, but I have to find, because I wanted to go to my content and then to my community section, so I didn't have to scroll down and look for the first comment I want to talk about. Sort by newest, yep. And we're looking for 29 metals. That was the last comment I did last week, and we'll do the first comment this week. But the first comment is, I've already talked about that. And the first comment I want to discuss is Josh Ackerman making a comment about me chasing after rich women during my US vacation. I did mention that on the fly. If I found a rich woman, I might just stay over there and stay on her ranch. That never happened. Funny enough, I did talk to a lot of people on my hikes. So I'm much more sociable on hikes than I usually am in real life. Well, the rest of my life anyway. And I did not meet one rich woman. That's unfortunate. Well, they might have been rich, but they didn't tell me. I did meet a lot of nice people, however. So that did not happen. Just Acronym also says CSL has two big red candlesticks. Have a feeling they're Might be one more coming down. Right grade comes in 3 rule. And then something about REITs on interest down cycle can be profitable. Yep, he talks a lot. I can not stand him. What was that about? There must have been a comment from somewhere. Sensei must have written something here, and it's just gone. Okay, so we'll talk about CSL. I won't talk about REITs. I'll talk about CSL. And it is true, though, however, catching REITs on interest down cycle can be profitable, but that's looking a little bit dodgy right now. Anyway, let's have a look at CSL. So I do own CSL right now. And I've been thinking it's attractively valued, but I haven't added to my position. And the main reason I haven't added to my position is because the chart looks terrible. So I think there is potential more downside coming. This could be the bottom, but there could be more downside coming. And also, we've had these 2 big drops. The first one was 19th of August, and then the AGM 28th of October. So there is that saying, downgrades comes in 3s. So I'm not sure how much validity there is to downgrades comes in 3s. I could actually search for this, downgrade, or do research. Downgrades comes in 3s. But it is a popular saying, I've noticed. In fact, I've used it. In fact, the most downgrades I've seen was from A2 Milk, who did 5 downgrades in a row. Anyway, I just did a simple search. Oh, no, it was yeah. No, I'll do this after I finish recording. Anyway, but the main thing is the chart looks pretty bad. The valuation looks really good. And I think the market is overreacting to downside. So I think even if you bought at these levels, you more than likely over the next 5 to 10 years will do pretty well with CSL. But there is potential more downside to come from here. So at this point in time, even though I do own shares, I'm not willing to add to that position because I'm probably being a little bit picky and looking for the bottom, sort of searching for the bottom. And I don't think I ever buy at the bottom, but I prefer to buy as the share price starts to go up than wait for it to, or buy now and see it drop further and further and further. Because technically, the share price of CSL could drop, say, below $100. It could drop to $50. Sentiment could be that bad. I doubt it, though. I think definitely there would be a floor. And I'm surprised the P ratio of CSL is at 18 right now. And I'm surprised it's gone that low. So that just shows you how the negative sentiment is in this company. And the company is growing at a better rate than most companies in the ASX 20. Yet the P ratio of CSL is actually below most of the companies in the ASX 20. But I think Josh Ackerman is right. Okay, Dan owns ZUT. Oh, is that New Zealand? I don't know. Given that you own and trade so many companies, how do you manage position sizing? Do you have a methodology that you follow? Do you give every trade the same amount of starting capital, or do you size your positions based on your conviction? So I do start with the same amount of starting capital, but then so for instance, it's $4,000 or $5,000. And then what I do is I will change that depending on conviction. So for this point in time, most of my small cap trades, I have low conviction in these, but potential really big upside. So low conviction means I could see the share price actually collapsing a fair bit, so lower conviction. So I put way less money in these because I'm less confident, I suppose. So low conviction, much lower capital in those sort of. So it's all conviction, yeah. So it's really conviction, yeah. So size your positions based on conviction. Yep, it's low conviction. So if I do have a high quality company that I'm highly convicted on, I'll put more money into that. For instance, say we had a big crash in the market, and say what's a company? Microsoft had a PE ratio of 12. I'd have high conviction on that, and I'd put way more money into those sort of positions. Yeah, so it's all about conviction. And I'll be honest with you, my conviction is typically quite low. I don't have that confidence and I notice quite a few people do have a lot of confidence. This company's going to do really well. But the problem with that is I think you can be overconfident, and that's how you lose a lot of money. I've known a lot of people who have lost a lot of money because they've been so confident on one company and they've lost all their money. In fact, I have a friend who lost all the money and this friend now believes the stock market is a gamble because of his friend losing all his money because he put all his money into one position, one company, and lost all its money. So I would never have that sort of conviction on a company. The only way I'd have that sort of conviction on a company is if I ran it myself. And I'm not doing that. Just acronym, Netwealth down 1/3 thoughts. So its thoughts are down 1/3. Interesting. This one is in my high quality watch list. So this is by my high quality filters. This company is considered high quality. And I do use their services. So maybe I'm a little bit biased. Well, yeah. So if we have a look at Netwealth's weekly chart, this is actually a chart of a high quality company. So listed back in, is that 2017, late 2017? Yeah, late 2017, share price below $6. Finally, we got the 200-week moving average in September 2021. And in fact, the share price has remained above it generally. Share price of Netwealth did go sideways for about 3 or 4 years. So it took a nice breather. Share price has taken off. A little bit of volatility in 2025. The share price is closer to 200-week moving average. So share price has dropped from 38 to 26. P ratio 55.75, but I would consider this company to be having the sort of growth along with Hub24 that probably justifies that sort of valuation. Let me have a look. So I think what you're going to see is pretty nice growth in revenue. Yeah, beautiful growth in revenue and pretty high margin in this sort of company, you would assume. Net income growing nicely. So revenue up 23.35%. Income at 32.65%, so margins have been expanding. That's beautiful growth in both of those, particularly income. And if we do have a back to overview, gross margin 66.5%, operating margins 50.5%, free cash flow margins 38.6%. So brilliant margins in this company. It has all the metrics of a high quality company. It's just a valuation. P ratio 56. So with this sort of company, with a 200-week moving average moving close to the 200-week moving average, I might even be talking myself into a buy here. If we have a look at the P ratio of this company since it listed, I would assume we've seen a bit of a multiple expansion. The market, maybe not. So P ratio right now is sort of normal. The lowest P ratio was during COVID-19, got down to 40. We've seen it get down as low as 42 back in October 2023. October 2023. That was right there. That was the last time the share price hit the 200-week moving average. So that's the sort of P ratio you might be looking for. And the P ratio also got down to 49.8 in this little dip here. So the P ratio now a little bit higher than the P ratio at those last 2 dips. So it's getting close to a buy, in my opinion. And again, it comes back to, would you consider this company to be high quality? Because if you're just trading this, I would say you wouldn't be trading this right now just based off the daily chart. It's actually looking weak. The daily chart is looking weak. So I wouldn't be trading this, but maybe for a long-term hold. That's just, again, this is all personal. This is how I do things. Okay. Fishbowl. Hi, here is a serious question for everyone here. What is your psychology to not sell stock so it does a multi-bagger? I find that I don't have the discipline, especially after stock doubled or tripled. I always tell myself I can sell it and buy something that has more potential. Selling is definitely harder than buying a stock. I do find that is true. It's less true when it comes to technical analysis, because if you have your rules, selling actually becomes quite easy. Selling becomes quite easy. What's a good example? Superloop. I was looking at this chart this morning. Superloop was a long-term hold for me. And there's me buying at 79.50. Look at that beautiful structure, beautiful breakout at that point. There was a takeover bid, if I remember correctly. I forget exactly what happened with Superloop, or maybe they won no, there was a takeover. No, I forget exactly what happened, but they won a contract over Aussie Broadband. I think that was the 14th of March, 2024. Anyway, beautiful chart, gorgeous chart. Even when the share price dipped in April, the structure really didn't change all that much. Share price going sideways for a little bit. Share price moved back into an uptrend, but structure started to change back in September and October. Share price got to a high of 350, struggled to get a new high, and you could just see the structure changing. No lower highs, no more newer highs, new higher highs. And then when the share price dropped below the previous low, that for me was a sell. That was a sell. And you can actually see the share price jumping up, retesting that breakdown and dropping away. So we can definitely see a downtrend forming here. So for me, when it comes to selling for technical reasons, it's actually easy because I have rules. When it comes to my high quality portfolio, for me, it's all about, hey, I've got it for a reason, just maintaining a holding as long as possible until the reason I bought in changes. Now, what I have found really hard, and I've already seen this, is my small cap portfolio. Alvo Minerals, share price rallied really hard after I bought, and I took profits. I sold out half. And that is where I do have problems because these are low conviction. And I went, oh, I should lock in some profits here. So I am already finding it hard to hold these for longer periods because lower conviction. So maybe it's all to do with conviction, I think. What else? Let's see what you said. Sensei says, scroll down the comments to see how all the 2,319 listings did in 2020 from a growth point of view. It's very hard to find a 2-3 bagger and even much harder to find a multi-bagger. My guess is people take a risk and go with a gut feeling, instinct, and magnify technical analysis in order to hold onto a stock to make it a multi-bagger level. Okay, so even though there's a lot of comments there, it was only about the one thing. Simon says, rest assured, Scentre might be late, but he has not forgotten the rally, and Wall Street was opened up overnight, wasn't it? I have not had a look at Wall Street. What did it do on the Friday session? Yeah, Friday session. I forgot today was Saturday. NASDAQ down 0.05 and Dow Jones down. Oh, well, that's virtually flat. So probably, small caps down 0.54%. But the big thing that happened overnight, and I did see this, silver up 7.69%, copper up 4.74%, and Palladium, the star of the day, up 11.69. Oh, nickel up 6.8. Did not see it. Oh, look at nickel. What's happened with nickel? Anyway, so stars overnight were, or the last, however, nickel, palladium, silver, and copper. So if they don't drop a lot, we're going to have a pretty good day on Monday, particularly in mining, particularly in silver, palladium, and copper, and nickel. So what's nickel? Looks like tin had a good day as well. Oof. So it should be a good day for mining on Monday. Maybe that will help our Santa rally because Wall Street didn't have a good lead-in. Method 341. Oh, actually, there's a few comments here from Method. The last time miners went up this hard was back at the beginning of 2022, and we all know what happened to the market that year. Miners are the only sector going up right now. Well, that might be true. Well, it's the best performing sector by far. We'll put it like that. It's the best performing sector by far. In fact, let's have a look at the XMM, which is sort of like the ASX 300 metals and mining index. And this is a beautiful looking chart. And 2022, that was sort of, back then, I suppose it was looking pretty good, 2022. But then there's a fair bit of volatility during that period. Then it went down again, then it went back up. This chart, right now, this chart looks much better. I think mining looks really good right now, which is why I'm trading a lot of mining stocks. But there's no mining stocks in my high-quality portfolio. But I am trading quite a few mining stocks right now. And there's a chance I'm going to build up my mining stock trading portfolio. And, yeah, that's all I got with Method 341. Okay. Oh, and some nice comments from Anderson. First of all, those weeks of weekly technical updates changed someone's life. Across the sea from across the sea from you, thanks. So Anderson is from South Africa. Found you 4 years ago when I found a technical person that also explained fundamentals. I'm an accountant, so fundamental my territory. Technicals confuse me. Well, technicals confused me for a period, and now because I'm just curious, I learned. and technicals, I wouldn't say they still confuse me, but definitely I'm much better situated right now than I used to be. Wanted to learn, says Anderson. I found a perfect teacher for me. Years later, I pretty much have the same systems you have. I run different portfolios, different objectives, and levels of risk and aggression in them. I understand charts now. I'm basically a clone of you. Are you attractive as me? That's a question. As ruggedly handsome as me? Is that the question? And my results have been massively different. My trajectory completely changed. You're having an impact that you might not have been aware of. I was able to fire and am now living the dream. Congratulations. Doing this daily, we appreciate everything you do. Thank you for that, Anderson. Very kind words you have there. And I think the most important thing here is same systems you have, but different objectives, levels of risk, aggression. And I think that's very important. You have to find what works for you. What I do more than likely won't work for you. Just find what works for you, which is the reason I get upset when you hear experts saying there's only one way to invest or trade. This is the way. You have to do it like this. And funny enough, I find most of the people saying that are fundamentally driven. Yeah, for instance, Phil Town. Oh, the reason I don't listen to him anymore is because on one podcast he said, the only way to invest is my way, which is the Warren Buffett way. That's the only way you're going to be successful. And I just went, no. And I have found a lot of technical people are way more open-minded. They will say, find what works for you. So that's another thing that's drawn me to technicals is I do find technical people to be way more open-minded. They say the way they might use technicals may not work for everyone, but when it comes to fundamentalists, a lot of them are very closed-minded. This is the way I invest is the only way you're going to be successful, which I do find a little bit arrogant, and hubris sometimes is a little bit too much for me. So thank you for all that, Anderson. VB says, hey, Kneppy, what do you think of Motley Fool tips? A few days ago, Motley Fool tipped at Lend-Lease for 2026, together with the Accent Group and Temple and Webster. I do know Motley Fool have a lot of different services. In fact, many years ago, I did test one of their services. It was like $99 for a year. I went, okay, I'll just test it. And they had one recommendation a week, and I did not follow them at all. I just didn't. I'm trying to think our services. Motley Fool services, I forget what they call. They have a hidden gems and a membership offers. Maybe it's this one. You can see massive new member discounts. I always get emails about this. They're massive. That's how the only reason I actually bought a Share Advisor. That's the one I got. Share Advisor. It was like $99 a year. Typically, it's like $5,000 million. And anyway, they would mention that if you look at the overall results, they've done fairly well in this Share Advisor. The hidden gems, I do know they had a really rough time a few years ago when the whole market collapsed because of rising interest rates. I do know that because they did recommend some companies. And I do know they recommended some companies because, well, maybe it was hidden gems I was a member of. I forget. Anyway, maybe I was a member of two. I forget. I had no intentions of renewing those memberships because I wasn't really worth it for me. But when you say Motley Fool tips, are you talking about in those sort of services we have to pay, or you're talking about something else they recommend? Because do they recommend on their normal website? Because they release a lot of articles. Like they have heaps of articles, and these are just simple articles without much meat to it. Usually they're just quoting from someone else. That sort of thing. Like these ASX 200 shares could rise 20 to 40%. Well, yeah, they also could rise 100%. They also could drop 20 to 40%. I don't like those sort of articles, but usually they're talking about someone else recommending something. So for instance, this is Morgan's. So they're saying Morgan's or Flight Centre could rise 20%. That's what Morgan's is saying. So they just sort of copy and paste what other experts are doing. And WiseTech, who recommended WiseTech here? Bell Potter. There you go. Bell Potter. So I have never seen them recommend anything on this website Only time I've seen them recommending anything is where you have to pay for it, like Share Advisor. Anyway, so if they did recommend Lendlease together with Accent Group and Temple Webster, what type of strategy are they using? Like Lendlease? I mean, Lendlease. I mean, I would say that Motley Fool would be more of the buy and hold for the longer term. So they should be looking for high quality companies. And Lendlease is no way a high quality company. The only reason I'd even be thinking about buying Lendlease is because the share price was near the GFC lows. That's the only reason. It'll be a technical reason. And actually, the share price has bounced off that. But that's the only reason I'd be even considering Lendlease. Definitely not a high quality company. So why have they recommended Lendlease? Accent Group, I could maybe understand Accent Group. Share price has dropped a lot, so they're probably thinking valuation here, good value, but the share price has dropped a lot. Is there any structural issues with Accent Group? I noticed there was quite a few comments about Accent Group, someone saying something. I didn't really look at that all that much. And Temple Webster, I don't think you could qualify this as high quality just yet. Might have the potential. Share price has dropped a lot as well. I think the only reason they've nominated these three companies is because share price has dropped a lot and they're thinking maybe they're good value, but definitely not high quality, any of those three companies. Even Accent Group, I wouldn't classify as high quality. In fact, let's have a look at Accent Group. Accent Group might be the closest one, but I don't think it would trigger my high quality metrics. Growth has been nice, but it looks like growth is slowing down. Return equity, return invested capital, a little bit lower than what I would like, and operating margins really low, which is understandable. P ratio says 9.7, but so maybe just value. In Temple Webster, I don't think there's value there. I don't know. Bet 3141 says they are a joke. And agreed. Anyway, so I don't really pay much attention to Motley Fool. And whenever I go to have a look at actually, I don't go here. I usually just Google a company and then it pops up an article they've released. Would I be mad to buy more CBA shares near $160? They like Warren Buffett, I think, which sort of makes sense. Here we go. Yeah, top brokers name 3 ASX shares to buy next week. Sort of like I do article reaction videos. This is sort of like a reaction to a broker recommendations. And that's what I'm going to talk about Motley Fool. Sensei says, thoughts on chart, future potential of RIGD, London Stock Exchange, Reliance Industries Limited, it's India's biggest company. I have no idea, never heard of this before. So your comment was chart, future potential. So is this just based off the chart? Now, RIGD, oh no, that's the wrong vowel. Oh, what's this? What is happening there? Is that it? Reliance Industries, LSIN. LRGD. Not even showing up here. Okay, I'll just have a look at this particular chart. RIGD. Oh, I put in the wrong. Here we go. Here we go, LSC. So they're listed on 7 exchanges, apparently. Okay, so let's have a look at the fundamentals of Reliance Industries Limited. And we can just have a look, even though I know nothing about this company. Just based on the CEO, yeah, it looks like they are Indian. Oil, gas, and consumable fuels. Okay, revenue growth, actually not. If you look at the 5-year period, 15.4% per year, earnings per share growth at 14%, that's actually okay over a 5-year period. But 5 years ago, it was COVID-19, or coming out of COVID-19. Gross margins, 36%, operating margins, 12.2%. Probably like to see higher, but it's okay. Return equity and return invested capital 5-year averages below 8%. So that's straight away a sign for me that this is not a high quality company. Market cap is 234.8 billion. So this is a pretty big company, probably the biggest company on the ASX if it was listed here. PE ratio 25.1. Okay, it's just probably the sector it's in is probably the reason why I've never really had a close look at it. Returns, if you have a look at the returns over the last 10 years, 17% per year. It's pretty nice. Over the last 5 years, 5.3%. Max, 10.9%. So sort of the returns you do look for in a company over a long period of time. And I'm talking about most investors would look at a 11% return as being quite good. And yeah, so the only question is, over the last 10 years, it's 17%, and the long-term return is 10%. So if it reverts to mean, you might not get a good return over the next 5 years, although the last 5 years it's been 5.3%. So it looks like between 2015 and 16, or 2016 and 20, was when you got really good returns with this company. And just based on the chart, yeah. Anyway, chart, why 69.50? Why am I not getting? Why am I only getting? Is that is that the chart? Why was these little weird candlesticks there? Okay, so this is the weekly chart. Just based off the weekly chart, if you look at the ultra long term, so if you go back here, you probably say this is not a high quality company because the share price got to high in 2008 and for the next 10 years did nothing, and the share price was oscillating above and below the 200-week moving average, which is indicating the share price was doing nothing. So that's a long period of time. But if you have a look at the chart from there, you might say this is a high quality company. So you get different perspectives. That's why the return in the last 10 years has been pretty good, is because of what's happened since about 2017. Share price took off. Looks like maybe the share price is going sideways now, consolidation period. Yeah, that's really all I got right now. Daily chart. Daily chart doesn't look that bad. If it gets above 72, it will be looking better. Yeah, that is the right chart, by the way. India's biggest company. You actually did say that. India's biggest company. There you go. I know nothing about it. I do know a lot of people like India for growth potential. Just acronym, Scentre selling off more assets. Why would a REIT sell off assets unless it's overpriced? My first thoughts when it came to why would a REIT sell off assets if it has too much debt, and there is a metric REITs have. They want to, I forget what it is. There's a, in fact, let's have a look at Scentre Group. There is a metric when it comes to debt, and they want to keep the debt manageable, and that's could be the problem, particularly if they have valued some of their assets. That's the only thing I can think of right now. Now, if I'm going to go to, we'll go to half year results announcement and slide presentation. I forget what the metric is, something to do with debt. And I do know they try to keep it below a certain amount or within a certain amount. And if it gets above a certain amount, then I have seen REITs actually sell off some of their assets to reduce their debt. And I'm trying to remember. I just wish I could remember that metric right now. Let's see if I can find it. See if we can. I bet we won't be able to find it. They are selling a lot. Although they do sell a lot. Looks like every single year. So maybe this is part of their philosophy. They just sell off assets, and maybe they buy new assets. I don't know. Yeah, future developments. Maybe that's their strategy. Is they develop assets and they sell them off. Here we go. No, yeah, I can't find it here. Oh, the gearing. Of course, it's gearing. It's gearing. Gearing 31.7%. I'm pretty sure that is probably what they want. Based off my memory, which can be really bad. 31.7 does. I just thinking 40%, above 40% gearing is a little bit high, and we have seen companies sell off when the gearing gets high. or REIT sell off assets when their gearing becomes high. But just having a look at this, the first time I've ever looked at this company, by the way, it does look like they do quite often sell off assets every single year. Total portfolio sales. Is that what that means? Business partner sales? Yeah, I don't know. But my first thought was answering this would be too much debt. Hills Dictionary, can you analyze nickel industries? NIC. Well, we just saw nickel price go bonkers over the last few days. Look at that. What's happening with nickel? And I'm assuming nickel industries is nickel. And oh, hello, nice looking chart. So that's a daily chart. Look like it's on the precipice of breaking out. Put a little line right there. And if the share price actually did get to its almost 1 year high on the last trading session, which was Wednesday, was it? Yep. And this chart, it's not looking that bad. And with the rise in price of nickel, not sure what's happening with nickel. Why did price of nickel suddenly go up? Did price of nickel suddenly go up? No, March 2022, no. Here we go. No, that's September. Okay. Maybe if I just put nickel, nickel and news, maybe there's something in the news. 14 hours ago, nickel intermediate product market under the Indonesian policies and supply demand situation. I do know, yeah, many years ago I did read about nickel, and there was some sort of Chinese Indonesian relationship that really affected something to do with nickel, which wasn't really bullish for nickel moving forward, but I completely forgot what that was. Okay, this is not what's happening with nickel right now. But anyway, the nickel industries chart looks good, and I'm assuming this is purely a nickel play. I'm assuming. I could be completely wrong. Yeah, it looks like, yeah, just based off Trading Views, description of the company, nickel. And what we're seeing with nickel right now, this could be a play. This could be a nice little trade. Yes, I am writing it down. Thank you for that, Hills District. Okay, a gap or a PAP. Guys looking for stocks that will 1 to 10 bag in the next 12 months. Want a nice basket of potential wife-changing monies. Okay. Already hold 40X, so 40 Medical, Loomis, Race Oncology, Artrya, and Electro Optics. Sold out of most of my gold and silver miners a couple of weeks ago, thinking high was in, but happy to buy back in. Hit me with the recommendations. Thanks. No one's replied. I find this sort of exercise really hard because you're talking about a 12-month period. So what I prefer to do with this sort of situation is just look for the catalyst before the next run in the share price. And that is what I'm doing with my small cap trades. I'm looking for the catalyst first. I'm not looking for a theme because themes can change during the year. I'm just looking at a catalyst. I do or am trading Loomis. What I'm looking for is a good announcement from a company and then get on board that announcement and the share price could go, insanely high. That is how I'm looking for a 10 bagger. So you won't find me making any recommendations right now. I have to wait and see how it just transpires. That's how I would find the 10 baggers, is just wait for the catalyst to pop up. And a lot of these companies have already run up a lot. And what I'm looking for is a company that's just started the run up, not have already run up a lot. Bradley McDonald wrote a really long comment here. If it wasn't for the US Army contract announcement by Electro Optics, I would be concerned of profit taking Christmas Eve trading. Perfect timing for this trade. I bought in for December. Merry Christmas, etc., etc. Electro Optics is a reason I've decided to also trade Droneshield. And he mentioned something here. Both have a sort of symbiotic relationship. If one announces a contract, the other also wins. I've noticed this as well. And I do own Electro Optics right now. It's in my super. So this is one of those companies that I've held for a long time. And just because I've held for a long time, it's in my super, and I am not complaining. The share price has run up a lot. Look at that run up there. Maybe a little bit too much volatility right now. I can see this share price going either way from here, because I would say there's going to be a lot of profit taking, but things just moving in the right direction. The breakout for electro-optics was back in May at $1.40. And that's a beautiful breakout. But if we compare, we can do this. Oh, no, we have to compare. We have to press the add button, not... how... If you just compare, so in fact, what I'll do is I will make it thicker, and I might turn it to... No, that's too... I'm trying to find a color. Maybe just black. There is definitely a relationship between the two here. There is definitely a bit of a relationship between electro-optics and DroneShield. I think just because they're in the same sort of space. Yeah, that's all I've got. There's definitely a relationship. I think even Elsight, there's a bit of a relationship there as well. There was another company that was benefiting from this sort of area, and the benefits, I think it was Objective. No, not Objective. I forget the company name. It's a much, much smaller company, and they make drone engines. And I thought, oh, what's that company called? I'm trying to think where it's definitely in one of my watch lists. It starts with O. OEC, Orbital. This company will get rid of DroneShield. Yeah, this company was looking like it was following that sort of same trajectory. Now it's just pulled back low. I don't know what's happening here. And I think the only reason share price popped up significantly back in July, August was because of this, what's happening in this sector. So I definitely can see a bit of a relationship between electro-optics and DroneShield. Ben Hutchinson says, nice to hear you consider Maas Group quasi high quality. Me also, I bought some stocks for my eldest 21st birthday. Stocks that he could buy and hold for the long term. Maas Group was among my picks. He was unimpressed when it initially went down, but now doing what it's supposed to. And isn't that the truth? I think I've mentioned this story a few times. I had two different people at work say to me, I bought into this company, it went down. As soon as it rises back up to where I bought, I'm going to sell. They didn't use the word dog stock, but you can definitely get that theme that when a person buys some shares in a company, they expect it to go up immediately. But sometimes you have to be patient. And anyway, so Maas Group, I do consider quasi high quality. And yeah, I think this one, by the way, the share price broke out, which I've mentioned already. Share price broke out, and it's a beautiful breakout. Oh, Hillgrove, showing signs of life. Might be leaving the station soon. Recent good news when they complete a second access corridor into their mine on budget, which will boost their production rate. Another comment from Ben Hutchison. This I am really focusing on right now, because we've seen a lot of other copper mining companies go, I wouldn't say bonkers, but we've definitely seen a shift in sentiment and the trend. We're not seeing that with Hillgrove right now, but I did put a line. If the share price gets above 4.2, which I think it will do on Monday, I think we've got a breakout. We also see really nice higher volume coming in. And a reason I think we haven't seen a breakout yet with Hillgrove, and even though we've seen increasing volume, and again, I've read this a lot of times, volume precedes price action. What I think is happening here is there's a lot of underwater investors, a lot of negative sentiment in this company. And even though we've seen a lot of volume coming in, we need to see all those ex-holders get out, and they're going to get out near the low. And I wouldn't be surprised to see this rally. So this is one I'm really thinking of adding as a trade, because we're not seeing that reaction yet to the share price, even though copper is rallying. Aries Resources, look at that rally. Sandfire rally. Now, you could say that Hillgrove is a much bigger risk, but these type of companies benefit more from a rising price of the commodity than Sandfire. And the other one, because I've got a lot of comments about this from the one person, 29 Metals. Yeah, nothing wrong with this chart. And they had a really good week. And there's other ones too, Fly, and I do have created a beautiful chart. Hillgrove is not a beautiful chart. Oh, and the other one was AIC Mines. So they've all got beautiful charts except Hillgrove. So I think Hillgrove, although what you could do is what I did with silver is just buy a group of companies and group of copper companies, and you'll probably do well. But Hillgrove, fine. I might get back into Hillgrove. Kelly Ma, a member. So Ben Henderson is a member. Kelly Ma is a member. Hi, Kneppy. I bought you hot chocolate today. Thank you. I actually did eat that hot or drink, not eat. Well, the amount of chocolate sometimes I put into my hot chocolates and cold chocolates, it is like I'm eating. Anyway, I bought you a hot chocolate today. Merry Christmas. KGL Resource, a copper developer. Just talking about copper, now we have a copper developer. The other sort of copper companies you could think of buying now would be copper developers. And I'm wondering if they are running up pretty nicely too. We'll have a look at with KGL Resources. Is like 2019 West African. Ooh, because I did buy in West African many, many years ago because of maybe not 2019. It was a little bit later than that. What are your thoughts on the charts of KGL and the charts of SNX? SNX is a gold explorer in USA and Saudi Arabia. SNX just made and breakout here. I do not have knowledge of charting. Okay, so let's have a look at KGL. KGL. I'll have a closer look at this company. We'll just have a look at the charts first. Okay, so this one is showing already the signs of. So this the market's not waiting for this developer; it's already going up. But again, this is, in fact, what I might do is put this into my copper watch list. There we go. Add it to my copper watch list. So the chart looks good. And again, the most important thing here is copper prices. If copper prices plunge, share price of this company more than likely will plunge. I won't have a look at, I'm going to see if they've released a presentation recently. I like to look to, I'm really lazy. I like to have a look at presentations. You could have, they did presentation on the 31st in conjunction with their quarterly report. They did a couple raising just before this. And so what you're saying is they're moving towards production, fully permitted, advanced funding process, first production in 2027, 10-year mine life. Probably would like that to be a little bit longer, but that's okay. More than likely, they'll be able to extend that mine life more than 10 years. Anyway, so I'm going to have a closer look at this. Thank you for that, Kelly Ma. So the other one was SNX. We'll have a look at SNX chart. So this is gold. You would assume the chart for this one will be looking good as well because it's gold and gold prices are doing well. Oh, no, you don't. In fact, this is the complete opposite. What happened the other day on the 16th of December? Share price sort of went up and then down. A lot of volatility in that one. SNX. Okay, so SNX awarded Advanced Saudi Arabia Gold Copper Project. Yes, I did say gold first, even though copper was mentioned first here. So you would think maybe this would be the catalyst for a bit of a re-rating, but we've seen a lot of volatility in this one. The volume was really good. I'm thinking, just based off this chart, that the low probably is around about 1.7 cents. So the low has been in, and you're going to see a bit of volatility before we have any breakout. With the share price rallying back in September, there's going to be a lot of supply on the market with people wanting to get out. So it's one thing against this chart. If the share price didn't rally then, the share price was going sideways and we saw a breakout above, say, 3 to 4 cents, that would be a really good sign. So not my favorite looking chart for Sierra Nevada, just because, you can just see the difference between that one and the other company, which I've already forgotten about, KGL. Yeah, KGL. So big difference. Way more positive sentiment in KGL. And the share price could go up significantly from here, but you can see the trend here. Okay. Oh, this is the one. Okay. So yeah. Mr. Jigger Seville. Hey mate, I've been telling you since late or last 2 years for 29 metals, and you said it's a shitty stock, just look at chart. Okay, so here is the chart of 29 metals, and we're talking about the last 2 years. And for the majority of the last 2 years, yeah, it has been a shitty chart. SHITTY chart. So we're going back 2 years. So we're talking about December 2025. So back in 2023, sorry, December 2023. Wait, on the wrong year. So December 2023, share price was, 50 cents. So there was nothing to like about this chart from December 2023 through to June of this year. So over the last 2 years, yeah, it's been a crappy chart for 18 months of that 2-year period. And it's looking good now. It's looking good. What can you say? It's looking good. So if you're saying overall 29 metals, yeah, I would say it's a crappy company simply because it's a mining company. And the funny thing is, you did mention you sold. If you thought this was a great company, you wouldn't have sold, even though the share price has rallied. You would have maintained a holding. So obviously you're just trading this. So if you're just trading this, yeah, the chart looks good. Chart looks good. No complaints about this chart. And again, just like other copper companies, the very important thing about this company is copper prices. Anyway, so the chart looks good. And they did go through a big flooding event, which is why the share price dropped. And by the way, if this was a great company, the share price would not have dropped from 288 down to 12 cents. That's what happened with the company share price. If this was the best company in history, it would not have done that. So it is still, in my opinion, a crappy company, but it's going through a really good phase right now. And the reason I say it's a crappy company, I'm going to say this for the majority of mining companies. It's a crappy company. You don't own it for the long term because it's dependent on the price of the underlying commodity. Anyway, and copper prices going up now. I'm not going to go through all this. Another one from Kelly Mar. Okay, so next resistance level for RocketDNA, in your opinion? All their clients are tier 1 miners like Volt, Goldfield, Sibanya, Stillwater, and BHP. This chart is looking good. Let's have a look at resistance. Now, if the share price is at an all-time high, there's no resistance, technically. So share price, when they listed back in 2018, wow. Went through a long period where the share price did nothing. Then all of a sudden, the share price has taken off. In fact, the share price went up 21.74% on Wednesday. And I thought, because the share price rallied a lot on Monday, then did nothing on Tuesday. And I thought maybe the share price would go sideways or even pull back a little bit, but it didn't. Kept on going up. And the volume is really good. So I do like this chart. Although I probably, not sure if I'd chase it here. I definitely could see the share price pulling back a little bit. Eventually. But if you have a look at the longer term, it looks good. The last time the share price was this high at 2.8 was in 2022 or late 2021. So we're talking about a 4-year high in the share price. And the reason that's important, 4-year high, is I would say, put a line right there, I would say there's a lot of shareholders now that are in the green. And the amount of shareholders in the red, probably not as much as you would think, because a lot of the shareholders who bought before early 2022, late 2021, they've already sold out because they've went, oh, this is dog stock. Share price has been lower since then. And during this 4-year period, they've gotten out. So there probably wouldn't be as much supply or as much resistance, or the resistance is not that strong. So there still would be some shareholders who see this rally in the share price and think, oh, now's the time to get out, finally. But I don't think there's going to be a lot of that. So there's not much resistance moving forward for RocketDNA. In fact, I typically look for 1-year high. If I see a 1-year high, I don't consider there to be as much resistance as you might think, because I would say most people don't have the patience and they get out. They just don't have the patience to hang on to a company whose share price is not doing anything for a 4-year period. I needed patience. With Gentrack. Gentrack was my go-to story when it comes to patience. I bought in Gentrack. Was it late 2020? Share price did nothing for 3 years. And I remember that time going, maybe I should sell. I had thought about that a lot. Maybe I should sell at this position. I was thinking, no, I think it's still cheap. I'll just hang on. And then all of a sudden the share price just broke out. Now, there is an opportunity cost. I could have put that money to better use. And I would think a lot of people are thinking that as well. Anyway, so looking pretty good, RocketDNA. And if you have a shareholding in that company, congratulations. Unless you bought unless you bought at the IPO and then you're still down a lot. D-Investing says, check out ETPMAG. Chart looking very good. New highs after 14-year pullback. I have never heard of this. ETPMAG. ETPMAG. Oh, physical silver. Okay, yeah, well, that makes sense. This makes sense. Yeah, so if you want to trade silver and you're not sure about which silver company, just do the ETF. In fact, this is probably a really good way to play it, is ETFs. So share price broke out, yeah, I would say the price of this ETF probably broke out back in April, May 2024, and it's a beautiful chart since then. You can see a lot of moving average crossovers. That is telling me really a sideways market. And since then, we've had no moving average crossovers, telling me the trend is pretty positive for physical silver. The only thing I might get a little bit nervous is you can see how silver price has just gone hyperbolic, maybe not hyperbolic, exponentially. They've gone up exponentially. The increase is I don't know what the best way to say it, but the price is rising at a great rate than it has been in the past. And typically, the pattern I've seen in the past, when I've seen this exponential rise in the price of something, you eventually see a significant pullback. And that is the only reason I'd be a little bit nervous when it comes to price of silver right now. If you go to the silver chart, by the way, that ETF is better than the price of silver here. But if you just have a look at silver, it has really, when it broke out in November, late November, 28th of November, 1 month ago, that was the breakout. The price of silver has really it's gone up 20%. No, not 20%. It's gone up 50% since then. So that is a pretty significant rise. And that's probably the only reason I'd be nervous right now. Okay, Fishball, I want to ask about your thoughts process that made you take a position on SGR, Star Entertainment Group. Is it a gamble? Trade because you see massive upside since it was a $6 stock before. If the company industry doesn't turn around, it doesn't look like Chinese gamblers are coming back. Also, they had been flagged money laundering, so it's unlikely they will risk doing that again. Would you do that standalone video on this stock? Because it's one of those common moments where investors start see a once upon a time solid stock which got hammered. Standalone video. Okay, I can do that maybe. This is actually really easy for me. I don't really care about all this money laundering, company, industry. This is simply a trade. And it may not against me. 60% chance, we'll say 70% chance this trade could go in my direction. It's just looking at this chart. They had a few positive announcements, a new CEO, and the chart is turning around. It's looking pretty good. I might prefer Sky Entertainment Group. I don't know. But they're both looking good. There is something positive happening in this space just by looking at these two charts. I might do a standalone video on that because I've already released why I bought Steadfast, so why I bought Star Entertainment Group as well. But it's a completely different reason. Fantastico mentioned that 60 million cap raise for Terracom was the company's entire market cap. Wowzers. Yeah, that's not good. That's all I'm going to say about that. Terracom. He also mentioned, or she, delay in approval does not mean it will eventually get approved. No, that's true. Delay in approval does not mean it won't get approved. And I was thinking about this. I would imagine that delay in approval slightly increases the risk, which is why the share price might drop. So a slight increase in risk with the delay. But you could also say if they want to tick all the boxes, less legal chances the delay won't be approved. I don't know. So maybe it slightly decreases risk. I don't know. But whenever you see delay in anything, in any company announcement, the share price will go backwards, but it doesn't mean it will get improved at all. Definitely not. The risk is still there. Motivational Flavio trying so hard not to FOMO into AYA. The valuation is extreme. Also, as a PME investor, there is no way the two could compare, but I'm seeing that a lot now. So many people are comparing or trying to compare Artrya and 4D Medical to Pro Medicus. I see 4D Medical as a better comparison to Pro Medicus, but my dad actually he bought into some 4D Medical, and I had to explain to him that the valuation of 4D Medical now compared to where Pro Medicus was at the same stage in its life is completely separate. Pro Medicus market cap at that point was below $100 million. 4D Medical is near $2 billion right now. So I think the reason why 4D Medical and Artrya share price are going up a lot is this, got to find the next Pro Medicus in comparison to Pro Medicus. Anyway, so if you have a look at Artrya chart, they are looking good. But I would be shocked. I'd be shocked if you don't see a lot of volatility in this company, unless they keep releasing really good announcements. So I could imagine a 50% decrease in share price at some point in the next few years. Now, the share price could go up to $10, and then you get the 50% decrease. But the chart is looking really good for Artrya. Lil X1 says, in reply to one of my banked videos, Pursuit of High Quality Stocks, Sanrio, I completely forgot what that company does, although they must own Hello Kitty. Slight memory about that. Found these two, PopMart and Plover Bay Tech. PopMart. I have not heard of these companies before. PopMart. Oh, share price has gone bonkers. What do they do? Specialty realty. What I'm going to do, design, development, and sale of pop toys in China. What the heck is pop toys? Am I such a fuddy-duddy that I have no idea? It's like a bobblehead. Is that what a pop toy is, a bobblehead? Pop toys. Sorry, that's just not my thing. Anyway, growth. Phenomenal growth. The revenue growth has been sensational. Earnings per share growth has been done about above 60% per year over the last 5 years. That is phenomenal. Gross margins, operating margins, really good. Return on equity, return on invested capital, really good. Everything here is pointing to a high quality company. Share price, though, has risen a lot. What is it? SEHK. P ratio 36.3 doesn't look too high. What is it? SEHK 992. I think they have numbers, don't they? Yeah, they have numbers on that exchange. Okay, so yeah, the share price has run up a lot since 2012. Well, a lot. It's gone from $20 to and we're starting to see a bit of a pullback. And based off valuation, it does look like this company is P ratio 36.58. Market cap is $265 billion. 992. I'm just going to put that onto my watch list. Ooh, interesting company. Thank you for that. And the other one was Plover Bay Tech. Plover Bay Tech. Oh, this is also on the Hong Kong 1523. Nice growth in revenue, earnings per share, gross margins. Yep, return on equity, return on invested capital, beautiful. P ratio 20.6 doesn't seem too high from what I just read there. So there must be something else happening here. Market cap is 6.51 billion. And let's have a look at the chart for 1523. Oh, look at that run up. Yeah, same time as PopMart. Share price went from $2 up to $7, and we have seen a bit of a pullback. I wonder if the weekly chart looks anything different here. Funny enough, with the weekly chart, you can see a fair bit of volatility in this one. Share price is well above the weekly average right now. Anyway, so thank you for those two. PopMart but they have the characteristics of high quality, but I don't know anything about them other than a very quick look at some of their financial metrics. Sensei says, do you use a free version of Fiscal.ai or Pro? Not the free. I use the Pro. Is it Pro? Let me have a look. I definitely pay. But I didn't think it was that much. Unlock Pro for free. Where is my settings? Account. Current plan, legacy plan, plus legacy. I don't know what that means. So edit subscription. Maybe I shouldn't be doing this. Maybe you can see all my details. I know you can't. So I'm on the Legacy Pro plan, $290 per year. Yeah, so $290 per year, US dollars. What was the question? Yeah. Okay, so I'm on the Legacy plan. So obviously they've increased the prices significantly since I joined up. And I think because the Legacy plan, I just pay $290 per year forever. I think, maybe. And finally, because my family or my sister and her family are leaving very soon, he just walked past me and waved, and I waved. Boxing Day sales were nuts. Shoppers spending like money is free. Peter Alexander, Medicus. Peter Alexander Premium Investments are very busy. Even Accent Group was busy. Only Shaver Shop was dead. Funny enough, every single time I go past Shaver Shop, there's no one in there. There's no one in there. Which I find amazing because they seem to be doing fairly well. So maybe it's all online shopping, which if it's all online shopping, why do they have shops? Anyway, so Boxing Day sales were nuts. I would never, ever go shopping on Boxing Day. Ever. It's not for me. But anyway, thanks for those insights, Just Acronym. Okay, that is all I have for this particular video. If you have any questions, any thoughts, if you want to become a member, join up. But I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.